Good afternoon, good day everyone, and thank you for attending our lunch hour presentation for Edinburgh Investment Trust. I am pleased to introduce its lead manager, James Uphaugh of Mojo Asset Management. If one is not already aware, Mojo took over as managers of Edinburgh in March 2020. Under Mojo, the trust now follows a diversified, stock-driven approach to UK equity investing, with the managers conscious that the strategy does not contain any inbuilt style biases. Likewise, under the stewardship of Mojo, the trust is also able to benefit from the enormous experience of these managers, with James himself having been one of the co-founders of Mojo Asset Management, as well as benefiting from Mojo's broader, close-knit investment team of 21+ professionals. As a matter of housekeeping, we have about 30 minutes for the formal presentation, with another 15 minutes afterwards for your questions. Your microphones are muted, but you can ask questions directly using the Q&A function, which you should be able to see at the bottom of your screen. There are quite a number of people attending this session, so please don't be disappointed if we are unable to address every question or topic raised. All questions will be shared with the manager, and we'll do our best to get answers back to everyone if we don't touch on your topic during the session. So without further ado, I hand you over to James.
Thank you, David, for that introduction. So, yes, as you said, David, we took over this very prestigious mandate in March 2021, and I've got a couple of clippings from that period because I think it's all too easy to forget what an interesting period that was. We obviously took this on with a degree of humility because this is a trust that's been going since 1889, but in terms of the record that we've achieved since taking it over, I like, frankly, to have performance slides, first slide. So here we go. We've had what our chairman of the Edinburgh Investment Trust described as a strong start to the performance record. And you can see in that last column, that gives you the calibration to that. So the all share 33.6, the net asset value, reduced by a little bit of gearing at 43.8. And then we, by a mix of obviously the NAV growth and the narrowing of the discount, we did 56.4. So, as the chairman says, a strong start, but it's only a start, 15 months, but all to play for. I don't want to sort of belabor the point, but obviously everyone knows that a management change is obviously associated with perhaps a sort of air pocket in performance. You can see that in this next slide. Obviously happy to answer questions on this at the end if you wish. But, what I thought I'd now do is just highlight two things, and I'm not going to belabor this, but just two quick things that actually the board of Edinburgh, when making the choice about who to appoint as the next manager and the lighting on Mojo, really zeroed in on, and they were obviously advised by Willis Towers Watson and Investec in their due diligence. So the first thing is they were looking for a manager with a long-term record of outperformance, and what we set out here is the outperformance record of myself at Mojo, and again, just look at the last column, the 2.7% per annum, which those of you who love the joy of compounding will know that if you do that year in, year out, it leads to quite a difference to the index. So 2.7% per annum pedigree of performance achieved in conjunction, obviously, with the next slide, which is the team I work with, because a lot of the fruits of this trust and other Mojo portfolios are obviously driven by the ideas that my colleagues and I, those analysts and fund managers, achieve, and also, frankly, the challenge that we think. So basically, long-term record, team dynamics were two things which the board alighted on, and I think are definite strengths in terms of thinking about Mojo. Now, in terms of zeroing in on the trust itself, the real, the twin objectives are obviously beating the all share, the NAV beating the all share, and looking to achieve dividend growth in excess of the UK inflation rate. And we're looking to do this, as you said in your introduction, with a diversified portfolio, so 40-50 stocks. with the interesting flavor, I think, that we have the ability to invest up to 20% of the portfolio in UK stocks. We've not used the full remit of that recently because sterling was at a very distressed level when we took over, and it's only recently that it's got to more normal levels. But we'll talk a bit later about some of the stocks which we have, and I think add a real nice edge and have definitely added value over the period since we've been running. In terms of our style, I adopt a total return approach, so looking to think about both the capital and income dynamics. I think that's so important. I think really dividends, and we kind of cleared the air on dividends over this last year, but I mean, I think all too often historically dividends were, if you like, I'd almost term them sort of feudal tithes, in that they were things which were distorting companies. And what I like to invest in, and what we like to invest in at Majetti, is companies for whom the dividend is a natural result of the cash flow statement, and one that allows the company to invest in the fabric of the company. And obviously, in working that out, there's a huge amount of really deep fundamental analysis that goes into both analysis of the companies and also the competitive set. And critically, really from sort of starting Majetti in 2002, we've had a strong sense that actually, Milton Friedman's view that actually the one responsibility of a corporate was to maximize profits was kind of a little bit skewed. And we've had this view that corporate responsibility, if you like, responsible capitalism, is crucial. So, it's no surprise to us that ESG has become so important in investors' eyes, because we've had it integrated really throughout. And just give you one very recent illustration. Those of you who love reading the FT will know that Anglo American has completed the exit from its thermal coal assets by selling the Colombian coal assets to Glencore, and that completes the process. And this is a process which we've been engaging with Anglo American on for a number of years, as they've basically pivoted their capital expenditure plans away from legacy carbon-intensive minerals to more future-facing products and minerals, such as polyhalite, which is a juiced-up fertilizer, or copper. So ESG really integrated throughout. And the final point I'd make on this is that actually, again, the board really alighted on this in their choice of Majetti. It is that, in terms of risk oversight, and remember there's a debenture here, so it's important critically when you're using a bit of leverage that the risk oversight really bites. And again, they looked at the process and liked what they saw. And obviously the aim is to outperform over rolling 3 years. We've obviously made a good start in terms of the first 15 months. And I'm showing here the first 14 months, but frankly, we just finished the quarter, and it was helped by CDR parking their tanks outside Morrison's office in Bradford, because that obviously led to the Morrison's share price going up, and we have a reasonable holding in that. The key point I'd like to make from this is obviously the discount moving in from a slightly uncomfortable 11% when we took over the trust to a more respectable, but I'd say, we're keen to do more on this, a more respectable 4% level of discount, but that will be up to share owners to decide, of which obviously I am a share owner myself. And then the dividend, the board, after much discussion, took, I think, a very measured decision to recalibrate the dividend down to 24 pence for this current year. That's paid quarterly, and still, if you think about where the share price is now, produces a nice underlying yield. Now, other presenters will have put their view on the UK, and I thought, I love newspapers and I often read them in hard copy, and so I thought I'd just sort of take a few excerpts from that. really trying to illustrate how, with the UK equity market, I really can't overemphasize the fact that the risk premium on the UK equity market, I think, is still pretty high and reflects the muscle memory of where we've been. It's things like Brexit. And then, frankly, it's things like in the initial phase of COVID, it wasn't really that well handled. And what I've done here is put one headline, which I remember vividly. And this was when we were taking over the trust and reorganizing, and it was sterling hammered as London prepares to go into lockdown. And this was sterling down in 119. And there was lots of sort of speculation that there'd be capital controls, all that sort of stuff. And, that for international investors was a real issue. But actually roll the clock forward. Massive amount has changed. It is chalk and cheese, frankly. And what I've done here is set one headline, which I thought was really important, and that was Nissan, obviously the Japanese company who deal in decades in terms of their corporate horizon planning, deciding to put down a decent chunk of capital to expand their Sunderland factory. Obviously, we know that how the NHS and Bingham have managed the vaccine project has been good. And I've put a little headline from a German newspaper there, which says, "We envy you," talking about the rollout and the speed of it. And then I've just taken a little picture from Wembley on Tuesday night, but I could have shown a little clip from the Murray match yesterday. I mean, what I suppose I'm really trying to illustrate is actually, whilst we're not totally back to normality, actually we're well on that road, and we need to get that into our thinking. Then in terms of the shape of the recovery, and yes, there are risks on this, but again, I think it's interesting to think about the UK and how we're doing. This is a slightly complicated slide, so if you just bear with me. What these do is the Citigroup Economic Surprise Index takes any data point and plots it against expectations at the time. So today, for example, the UK Purchasing Managers Indices for manufacturing has come out at 63.9, which is a barnstorming number, because 50 is flat and below 50 is contraction and above 50 is expansion. So 63.9, a barnstorming number, but not quite matching average expectations with 64. So you might see a tiny tick down on this. But the key point I'd say from this, and you look at this visually, we've got the UK, you've got the US, Europe and China. And what you can see here is that rarely does this line go much above 100, because it mean reverts, obviously, because economists get overbulled and then expectations don't quite match that. But the big thing to say is that the UK is still showing very robust numbers relative to expectations on average. So is Europe, and maybe the US not quite matching expectations. And this is obviously a dynamic which we've seen over the last month or so. If you like, the second derivative of growth expectations are coming under a bit of pressure. But critically, I would expect the pace of growth still to remain at a really good level, and we can explore that in questions if you wish. But really, this is more a slowdown rather than anything else. Now what I'm going to do is, in terms of looking at expanding a bit more into the market view with those few points as backdrop. Now we're seeing quite a strong recovery. When we come to look at some of the transactions, we've been adding to a number of the companies which are looked to benefit from the reopening of economies. And you know, I wouldn't underestimate the scale of, if you like, the savings lake that in some segments is going to be channeled into areas. And what really matters is that actually in many of these areas that's going to be channeled into, the competition has been really whittled down. So actually one could be really quite surprised by the scale of market structure changes you're going to see, and a big focus at Majedi's analysis is on exactly that. Obviously, we're seeing a number of bids from private equity firms at this very moment, and I think that really does underline the opportunity that there is currently in the UK equity market. And as I said earlier, we're also accessing a number of what I think are really interesting opportunities on the non-UK listed names as well. Now, in terms of the year-to-date activity, I put down here the larger sales and purchases. I'm not going to sort of run through all these, but I'm obviously happy to answer individual questions on some of these, you know, if listeners wish at the end. Maybe just to frame a couple of the purchases, perhaps the sort of the EasyJets and Compasses of this world, because to me what they illustrate is, you know, a really big theme in this portfolio. For want of a better word, we call it sort of Darwinism, this idea that the strong, you know, what we're seeing as we emerge from you know, the economy having been put into lockdown by government is essentially you've got a whole load of companies, market leaders and the like, who are really emerging in a very muscular way on the front foot, you know, really taking it to the competition on multiple dimensions. And then there's obviously the sort of walking wounded. And what I'd also say is that many of the incumbents have also had the opportunity during COVID to restructure their cost base in a way that makes their competitive position even stronger. So for example, you know, if you think about a company like EasyJet grew pretty quickly and perhaps didn't grasp the nettle that actually cabin crew and pilot rostering and employment terms were getting a bit too close to the legacy carriers and away from the low-cost carriers in terms of the terms of employment. And you know why that matters from a corporate perspective, obviously, is it makes it a bit more difficult when you've got a very seasonal business to access some routes. So EasyJet during COVID went to the unions and their employees and said, look, we have a choice. We either make sadly a number of people redundant, or we amend some of these terms. And the net result was that the pilot and cabin crew rostering terms were changed, and that allows EasyJet to access routes that they weren't able to because they can make the winter schedule work in a way that they couldn't before. So here's a company which, from a Darwinian perspective, is going to emerge a lot stronger. Compass, again, is a similar type issue, but sort of different dynamics. And if you just bear with me, I'll just sort of illustrate that. So if you think about what Compass does, it's you know, it's obviously food and beverage catering for corporates, the likes of Google, some less glamorous corporates. It's obviously institutional catering, it's sports events. So obviously very mixed profile. But what you're seeing from most of those clients is a focus on trust. You know, obviously you want to make sure that the meals are you know, done in a way that's sort of very hygienic. You want a focus on sourcing, and also you need a company that can put in the initial kit for the project. And you know, the likes of Compass is one of very few that actually can afford the initial costs at the moment, because most of the companies in that area, obviously having been through lockdown and also were very leveraged before, whereas Compass is not. And so they're able to afford the capital going in a way that others aren't. And what also many clients are demanding, and this is obviously across the world at the moment is that corporates are looking to achieve carbon footprint reductions, and so they're working with partners who can measure and manage, if you like, that equation. And Compass is able to do that in a way that others are not. So, you know, Darwinian theme is a big one, as I say, and one that we've been emphasizing, and one that's working in a way that actually is almost greater than we expected. The next slide shows a portfolio snapshot, and what I'd say to listeners, you know, if they're interested in, you know, tracking the trust project fund over time, obviously there's a fact sheet on our website which also gives information on this. And what I say to you is this really gives you a sense of the scale of the active positions that we look to have at any point in time. So you can see there top right, you know, the biggest positions in active positions are things like Ashtead, Weir, Electric Components, Hayes, and Anglo American. Now, the next slide, we've had some fun with some logos here. And what I'm really looking to do is illustrate that actually the trust is multidimensional in terms of themes. So on the left-hand side, on the vertical side, you've got a number of the themes there. So I've talked a little bit about Darwinism, but, you know, if I just illustrate that, you know, Serco, for those of you who look very closely at markets and perhaps read the Serco statement yesterday, you'll have seen that, you know, their new business wins are strong. It reflects the fact that, you know, they are one of very few counterparties that many governments can trust with a number of the, you know, quite sensitive things that they do, be it defence or other issues. Bellway, the house builder. House building is interesting at the moment because there are a number of environmental rules coming through in terms of household emissions, which new build will have to incorporate. And if you're a mid-size or small house builder, this is a massive, massive headache. But for the larger players, actually, it's something that they've been planning for. You know, they can build, if you like, dummy homes that incorporate the product. And so, you know, when it comes to this, which, you know, it could be like £15,000 extra for a new home in terms of the build, you know, actually minimizing that cost and making it in a way that really works for both the consumer and also the profit margin is a big, big issue. So I think it's going to be another thing which makes a difference between the winners and the losers in the industry. So Darwinism, a big thing. Another big theme is scale. You can see there right at the top. So one of our largest positions is Ashtead. I'm sure you'll know what Ashtead does. It's it supplies effectively sort of hire kit, anything from excavators through to, you know, stuff for distribution centres. And I'd say that, you know, the real issue there is they can buy substantially cheaper than the competition. So that's one angle. Also, if you are wanting to hire something, you want to know that something's available. And obviously, Ashtead, with its greater depot density, is more likely to achieve that. Also, you've got a technological interface which allows them to give you the clarity that that is going to occur. And also, if you think about a number of the other dynamics, if you're hiring kit, you want to make sure, particularly over this period, it's relatively clean and in good shape. And again, Ashtead is probably better placed for that and hires higher net promoter score. And also, there's a slight angle which I think people are going to focus on more, is that actually if you hire a product as a bigger company, actually you reduce your carbon footprint more than if you buy an excavator, let's use that example. If you buy an excavator and don't use it a lot, actually it's not very environmentally friendly. Much better to rent it. And then, you know, sustainable advantage and low ticket consumer spending. You know, I highlighted, you know, Greg's here. I put that there because, you know, this morning when I come into the office at 7:30, there aren't many places you can get your coffee and bacon roll, and you certainly can't get them for an all-in price of £2.30. So there's a lot of consumer surplus there. And also, just to give another little example, you know, you have to queue to do that. Morrison's, well, you know that there's a few developments at Morrison's, but you know what I'd say, both Tesco's and Morrison's, they have reduced their price dramatically, so they're now very competitive or within competitive distance of the discounters through things like Aldi Price Match. I've jumped ahead a few slides. Now let's go back one slide or two. I think the key point I'd say is, you know, coming back to an important point which we talked about, you know, ESG is integrated throughout, and one other dimension we're very careful about in this trust is ensuring that the weighted average carbon intensity of the portfolio is below the index. So here what we do is we source the data from MSCI, which shows that the trust is indeed below the all share index, which I think is important because, you know, we want to achieve good outperformance, but we want to achieve it in a responsible way for our share owners. So 2 more slides. I mean, really what I'm trying to show here is I feel very strongly that we are in the early innings of the UK equity renaissance. You know, the risk premium on UK equities, I think, is still high. We've got within this portfolio, I think, a really interesting range of companies. And, you know, the last 15 months or so, we've been engaging with our companies. And I'm constantly really impressed by the scale with which and the depth with which, you know, these managements are looking to grow their businesses in a really thoughtful way. And what we've also got is on the bottom right, just an illustration of a couple of the non-UK listed shares where we're looking to access a couple of themes which we can't do through the UK equity market. So, you know, I think a recurrent sort of bugbear of the UK equity market, which I think frankly is overrated, is as in that particular issue, that particular bugbear, is that, you know, you can't access quality technology names. Now, we've bought NXP, which is a world leader in semiconductors for the auto industry. It's got nigh on a 40% market share. And what's happening, obviously, is the semi content in autos is going, it's doing a moonshot. It's doing a moonshot because as people trade up, you need more semis, even in internal combustion engines. But obviously, we've moved to EV, it's even more. And also, as we move to assisted driving, even more. So, you know, the semi content is really going off the Richter scale. And then we've got Newmont to access the gold price, and Maersk to access the importance of supply chain for customers and logistics. And that's becoming an increasingly tech-heavy business in a really exciting way. So my last slide, and I've got a minute before the half hour is up. My last slide is really just to conclude. And, you know, from my perspective and Majedi's perspective, this is a really important project. We're 15 months in. We've got here a really nicely calibrated, punchy portfolio of primarily UK stocks with a little soupçon of overseas non-UK listed stocks throughout this, we have running like a stick of rock through the stick of rock the ESG issues to ensure that it is done in a responsible way. We have a little bit of financial gearing just to endeavour over the medium term to marginally recalibrate up returns. The dividend is now rebased. It's at a level from which is attractive and it can grow. And crucially, we've made a good start, but it's only a start. And what I'd say finally is I'm very aligned in this project, having bought, a reasonable chunk of shares over the last 14, 15 months. So, that skin in the game aspect is there. So with that, I'll pause and prepare for the odd question.
Thank you very much, James. Now we do have a decent set of questions coming through. So we do have a couple I want to collate around the dividend, the underlying dividend for Edinburgh Investment Trust. Just if you could provide some colour about how well you think it's going to be covered by the revenue reserves, some comments as well about whether if you want to take a more, I think, growth or capital growth more on the forefront, will that impact the ability to generate it? And I guess if you have time or the ability, some comments about the general dividend outlook for the UK as well post-COVID.
Yeah, so the first thing to say is that in setting the dividend at 24 pence, the board obviously iterated with us a number of scenarios, and we put together obviously a granular spreadsheet looking at our forecasts for the individual companies' dividend prospects over time. We did this in the fourth calendar quarter of last year, and those tramlines are still there. Obviously, we're at the point where the 24 pence to pay that is to a degree dependent on use of reserves for a period, but it gets to the point where we get to a crossover in a reasonable time period, hence why I say it's sort of a prudent recalibration. I think a broad point is I'd say that, arguably the UK equity market was perhaps over-distributing. You can see that, frankly, in the moves for things like Glaxo, for example, one of our largest companies, which recalibrated down, is recalibrating down as part of the demerger, or Shell, which obviously cut its dividend. And in a way, COVID has provided the opportunity, if I could sort of put it like that, to sort of clear the air. We've now rebased down to a level where dividends are sustainable and on average can grow at a reasonable level. But I think most boards will be a little bit more cautious about how quickly they grow their dividends, having worked through this period, and I think you can understand that. But nevertheless, I think when you take a step back and think about what the UK equity market offers, both as an absolute starting point in terms of yield and probable growth, and you compare it to most other assets, I think you find it a pretty good prospect.
Speaking of, I guess, other assets, I suppose, can you just also talk about, I guess, to some extent, your flexibility to invest outside of, I suppose, the conventional names that many investors would look for, especially in the case of income trusts in the UK?
Yes. So we're lucky enough at Mojo to have, if you look at the slide which I've just put up here, a number of my colleagues run, top flight global funds, top flight US funds, top flight hedge funds, and their remit is often, as you'd expect, mainly global. So we do pick up on a number of interesting opportunities, which I'm able to access. And the proof of the pudding is the last 15 months. If we look at the shares that we've had, things like KPN, Newmont, Maersk, and NXP. If you look at the cocktail of that, it's been a pretty good one. NXP has almost doubled since we bought it. Maersk is up 50%. Newmont's up probably 20%, and KPN is up sort of 15 or 20%. Both of those previous ones have paid decent dividends. And in each of those instances, really, we're accessing things we can't get in the UK. So, for example, in the case of KPN, which is a telecoms company in the Netherlands, what you get there is you get access to a 3-player market, and also in Europe, if I was to generalize, people buy telecoms slightly different from how they buy it here. So here, if you tend really on average to buy your broadband and mobile from different suppliers, obviously companies are trying to sort of converge that, whereas in Europe there's much more of a converged offering. And the interesting thing is, to get to that converged offering place, you have to offer consumers a better deal. But once you've got to that point, there's less churn. So the quality of that customer relationship is higher. And KPN's speeds also on the network are pretty high. So KPN is about to get to a point where free cash flow is about to do something of a moonshot, and it's got a nice yield. And so it's unsurprising that 2 bidders were looking to take that out, according to a statement which they issued probably about a couple of months ago. So in each of these instances, there is a special, there's a really special reason why we're accessing them, and we can't access them in the UK. I mean, something like Maersk, you might think, well, it's just container shipping, and yes, the consolidation angle is a really strong one, but the really interesting thing is that what it's also trying to do is it's trying to get extra share of wallet, if you like, with existing customers, because many of its customers are just using it to actually do the shipping rather than do the full logistics from end to end. And if you could do the full logistics from end to end, you not only get a better client experience, but also Maersk obviously is able to do things in a more differentiated way and make decent margin as a result. So, we feel pretty good about our non-UK exposure, and I think looking forward, it should be something that we will dial up a bit, and hopefully will continue to be something of an added value for the trust.
Touching on Maersk as well, following up with another question, how could you just dive a little bit deeper, I guess, into the sort of valuation approach that you used around Maersk? I mean, so what was the initial trigger to it? What sort of target exit price, things like that?
Yeah. So I and we do spend quite a lot of time looking at market structure changes, and the container shipping industry was a savagely cyclical industry with very low returns. And what we saw is that change, with a bit of consolidation and a bit of reorientation into alliances. Why this matters is, in the last downturn, what happened was when there was a downturn, the individual companies found it very difficult to adjust capacity in anything other than a very blunt way. So they kept all the capacity in, so it led to rates going down a lot. Now, and this is a feature, I think, for many cyclical industries, now with a more consolidated industry, they're able to adjust shipping capacity more in line with demand. And also, and this speaks to many industries, frankly, it's true of the plant hire industry, it's something which Asched experience. There's also more data on rates. So industry players are a bit more able to feel their way to where the equilibrium rate is without actually cutting rates too much. So what we've got an industry that is more rational, at a point where when we bought it in, it was effectively once times invested capital. Returns were around cost of capital. And we saw the prospect of returns, moving up quite a bit. And the added spice, if you like, is that within Maersk there is this drive to give. Effectively, it is true of so many industries. What they're doing is they're taking out a lot of the paper and dockets and other things that were associated with trade. Now it's much more straight through processing. If you're a client, you can see where your container is, etc., etc. And there's this product called Trade Lens, which they have, which those of you who are interested can Google, and you can see what happens. But the net result is it's a better customer experience because you know roughly where things are. It cuts the cost for Maersk, and to a degree, it's something of a barrier to entry. So it's it's one of many industries, I think, that is using technology in a clever way, and so. I think Maersk has obviously done pretty well recently, but I think it's got a bit further to go, in my view.
I'm conscious for time as well. I don't think I'll be able to ask every question I've received, and apologies. I guess I'll let you sign us off with this one. Where do you feel, I suppose, about the UK market? I guess you mentioned it's undervalued, but how is it relative to the rest of the world? I guess the case for a relative play in the UK against something like Europe or the US?
Yeah, I mean, I think the answer to that has to be really to look at things like cyclically adjusted PE ratios, or or those sort of metrics. I think it's it's slightly difficult really to sort of generalize, but whenever I do look at comparable companies, so sort of Unilever against P&G or Tesco against Walmart, Tesco against Kroger, whenever I try and do a like-for-like comparison, I do find myself thinking that the UK company that I have is cheaper, but I think it's quite difficult, if I'm honest, to really sort of come at a generalization of that. I think all I'd say is if you take my premise that actually there was quite a lot of risk premium built into the UK equity market, it feels to me like there's quite a lot to go still on that front.
Thank you, James, and thank all of our attendees as well. We are coming up quarter to the hour, unfortunately, so that is all the time we will have for questions. Just like to remind everyone as well that our next presentation will be the roundtable titled "The Small is Beautiful," which will start shortly. If you haven't registered already, you can do so via our website. If you have, there should be a placeholder in your diary. But in the meantime, I would like to thank all of you for joining us. And I would like to thank you again, James, for taking the time today to give us an update on Edinburgh, as well as just the case for the UK market in general.
Thanks, David, and thank you to the listeners.
Thank you all. Goodbye.